je cherchais mes speakers, moi. Parce que je gère la session. Super, donc toi t'es là. J'ai Milo, j'ai Laurent, j'ai Romain, il me manque Béatrice. Et si comme il nous manque Béatrice, je pense. Déjà tu peux t'installer toi. Bonjour Béatrice, je t'attendais d'être sûr qu'il y ait au moins la... Okay, so I think almost everyone is here. Well, at least I have the first 5 speakers, which is great. So welcome to this session on Robo-Advice. We have 4 papers presented, 2 discussants who will each combine their discussion of 2 papers. And the first speaker is my dear colleague Milo Bianchi from TSE, talking about can robo-advising reduce inequalities. Milo, Robo, you have 20 minutes. I know.
So thanks. Thanks for having our program, our paper in the program. The paper is joined with Marie. And
You have to stay there.
yeah, sorry. Okay. The paper. No, it's fine. The paper is joined with Marie, and we're going to ask whether Robo-Advice affects inequality. And just to put this in perspective, essentially we're trying to combine 2 literature. One, trying to understand sources of inequality in financial markets. And there is by now a pretty large literature on which Laurent, for example, has contributed a lot. Showing how different households have different performance in financial markets, in financial decision in general, and how these differences are important to understand long-term pattern of wealth inequality. And then there is a second literature on Robo-Advice, which is also interested in understanding whether financial advice can reach people who have been traditionally underserved, with the idea that especially those with low literacy, low experience, are the ones who gain the most, or could gain potentially the most from robo-advising. So we want to look at whether robo-advisor affect inequality, and we're going to look here at essentially 3 dimensions, which is inequality along age between young and old, between men and women, and between poor and rich households. And we start with these categories because those are categories which have been emphasized in the household finance literature as being particularly relevant. And the robo we are going to study is a robo which is unaware of these characteristics. So we're going to ask whether even if a robo does not condition his advice on this characteristic, can still have a heterogeneous impact and create or dampen inequality along this dimension. And I'm going to structure the result or the presentation into essentially 2 types of effect of the robo. One is going to be what I'm going to call the direct effect of the robo, which is just driven by the way in which the robo is designed. The way in which the robo builds a risk score or profiles different clients and gives recommendation. Is this already a source of inequality? And so the thought experiment we have in mind is, suppose that everybody was forced to take the robo and to follow the robo over time, what would be the result on inequality? And then there's going to be a second type of effects, which I'm going to call the indirect effect of the robo, which are mediated by the behavioral response of the household to the robo recommendation. So depending on whether different households respond differently, either when they want to decide where to take up the robo or when they have to decide where to follow or not the robo, this again might have impact on inequality. So the context I'm gonna use to study this question is one in which a robo-advisor was introduced by a large French asset manager on a set of employee saving plan. So employee saving plan, as you know, you are an employee of a firm, you get some money from your employer, and you have to allocate this money typically for your retirement. And what the robo is doing, so typically this investor were self-directed. They were taking decisions on themselves, and the asset manager came in and say, let's have a robo that suggests people how to allocate money. So the robo will start by asking questions and build the profile of the investor, essentially based on the risk tolerance of the investor and the horizon. And based on that, it will suggest the portfolio allocation. And then an important feature of the robo is that it will follow the investor over time. So if the current allocation of the investor is far away from the target, which was agreed with the robo will send email alert saying, you have deviated, you can connect to the platform and rebalance your portfolio to stick to your original plan. A second important feature of the robo that we are studying is that investors here are the ultimate decision maker. So this is not a somewhat more common robo manager in which the investor completely delegates the decision to the robo. Here, the robo gives recommendation, and the investor is always free to follow or to ignore this recommendation. And third important feature of the robo at hand is that the sample is essentially representative of the French population working in the private sector. So it includes a lot of investors with small portfolios, with little experience in financial market. And so we are going to be interested in understanding the effect on financial inequality, precisely in a setting in which there are a lot of small investors, and precisely in a setting in which these investors have the freedom to choose and freedom to follow or not the robo. So specifically, the robo was proposed to employers starting in August 2017, and we have monthly data which starts a bit before the introduction of the robo and in June 2021. And the data you're going to see today is mostly comparing people who have taken the robo as of November 2018, which is when we started long ago working on this project. And then we want to compare them to a somewhat comparable group. And we are taking as a control group in most of the analysis what we call robo-curious. Robo-curious are those who have expressed interest in the robo. They went through the profiling survey that the robo is proposing, and then at some point they stopped, they didn't take the service, okay? So these are an important counterfactual sample, because we know for them what the robo would have suggested them to do. And so we can compare what the robo is doing to what the robo would have done had they taken the robo. Okay, and for this investor, we have portfolio choices, we can construct return, the risk that they exposed to, and then we have data that the robo is producing on the type of risk that the investor can bear, the allocation of the robo, and so on. Okay. And then with this data, we are going to show very standard result on diff and diff, right? So showing how a given outcome of interest, let's say equity exposure, changes once people take the robo, as opposed to the change that you observe in the control group, which is the robo-curious investors in our case. Okay, so the starting point is one in which we observe pretty large inequality across investors, not only over time, but also across investors, and one in which this inequality are systematically related to demographic characteristics, and this relation changes before and after the robo. So I'm going to show you I'm going to show you just a picture of the sample before and after the robo, based on equity exposure. And the result on returns are actually very similar. So on the top left, you have a graph showing the violet line, the violet bar is how the equity changes after the robo based on your baseline, on your equity exposure before the robo. So the black one is before the robo, and of course those who had so you see the pattern of equity exposure, and then you see that after the robo the distribution is more compressed. Okay, there's less difference in equity exposure after the robo, so the violet relative to the black. And then you can look at how this is related to different demographic characteristics. For example, you see in terms of gender that male and female had similar equity exposure before taking the robo, the black bar, and after there is more difference. The relation with age is slightly increasing before the robo and more flat after the robo. The relation with baseline wealth is clearly increasing before the robo and flatter after the robo. Okay, so the story we're going to build, and again, if you look at returns, is a very similar story. So the story we're going to build is one in which the robo is compressing the distribution of equity and of returns. But these effects are heterogeneous across demographics. And in particular, when you look at inequality between young and old, this type of inequalities tends to be reduced. Inequality on poor versus rich, this type of inequality also tends to be reduced. While if you look at inequality between men and women, this inequality tends to be increased with the robo. Okay, so the paper is about understanding how much of this, which is just a picture, is driven by the effect of the robo, first, and second, distinguish what could be the direct effect of the robo, meaning the way in which the robo is built. And if this is the this is the source, then we can think about how to change the way in which the robo is built. Or if it's the behavioral response of the household to the robo, and so if this is the issue, then we're going to think about how to change the behavioral response. Okay. So that's the paper, that's the exercise that we're going to do. So let's start with the direct effect. Suppose that everybody takes the robo and everybody follows the robo, what would be the impact on inequality? And to understand that, we start with the way in which the robo is proposing equity, exposure to different investors. And essentially what you see here is that if you have more equity to start with, the robo tends to propose more equity. If you are older, the robo tends to propose less equity. If you are female, the robo tends to propose less equity. And if you are wealthier, the robo tends to propose more equity. Now again, the robo does not know these characteristics. Okay? It does not know your wealth, does not know your gender, and so on. The robo is just caring about two dimensions, which is your horizon. So it's asking you, what is the horizon of your investment and your risk tolerance. So it's asking you, is making you play some hypothetical lotteries to see your risk aversion, is asking you how much you know about financial markets. So based on that, is creating an index of how much risk you can bear. And so to the extent to which this, for example, risk tolerance is correlated, let's say, to your gender, then the robo will give different recommendations to men and women. Now, of course, not everybody is starting from the same initial conditions, so different proposals result in different change in equity. And so you see that this is the resulting change in equity given by the proposal of the robo. And so you see in the first column that what it's telling you is that those who had more equity to start with have a lower increase in equity due to the robo. Those who are older have a lower increase in equity. Those who are female have a lower increase in equity, and those who are wealthier have a lower increase in equity. Okay, so in terms of equity exposure, you see a compression of the distribution of equity, and this compression is particularly strong when you look at the difference between men and women. The compression is particularly strong when you look at the difference between old and young and rich and poor. While remember for female, they had pretty similar equity exposure than men. But because the robo is proposing less equity to women, at the end of the day, after the robo is introduced, females tend to be less exposed to equity than men. Okay, so just to give you a sense of the difference, I mean of the magnitude, if you compare those who start, let's say, at the 25th percentile in the equity distribution before the robo, which had no equity, and those who had the 25th percentile, which had 22% of equity, you see what happens to them after the robo. Basically, the difference after the robo is 5%. So the robo is proposing 5% larger equity to those who had larger equity to start with. But the initial difference was much larger, okay? You start with a difference of 22%, and you end up with a difference of 5%, okay? So the distribution of equity gets compressed. And similarly, the increase in equity, as I was saying, is lower for older investors, essentially because the robo thinks that they have shorter horizon, or they declare to have a shorter horizon and a lower risk tolerance. There is a larger increase in equity for poorer investor that was also tempering the baseline difference, and there's a lower equity to female, essentially because they are coded as being less able to take risk. Okay, and this is a result we're going to go back to, because this is connected somehow to a literature in household finance that is documenting how when you ask the same question, let's say about risk aversion or about financial literacy to men and women, they tend to respond differently. Okay? Even controlling for, let's say, objective characteristics, they tend to respond differently. And in particular, women tend to underestimate or underreport their financial literacy. So that's sort of opening up a little bit a discussion, which I'm going to take 2 minutes at the end to talk about, on whether the robo, what would happen if the robo could sort of correct for the difference between men and women. Okay. Okay, so that's what happens just driven by the profiling of the robo. And I'm sorry, I'm not keeping track of time, but you tell me, okay? I am. 5 minutes. So then you can look at the total effect of equity exposure. So this is not only happening at take-up, when you take up the robo, but it's happening throughout. And in particular, remember, a key thing that the robo is doing is to send alert whenever your allocation deviates from the target. The robo will tell you, you have deviated, you can go back, or please go back to the target. Now, if you compare the total effect of equity, the change in equity due to the robo to the one occurring at take-up, you find very similar result. What does it mean? It means that most of the increase or the change in equity across investors occurs at take-up. After take-up, the differences are very small. Okay, so if you want to explain the change in equity across investors, the thing that you care the most is the way in which the robo is constructed, okay, more than the behavioral response of the investor. Now, the behavioral response of the investor, do they matter? Yes, they matter if you look at the change in returns. Okay, so returns are not only driven by your average equity exposure, but they're also driven by the way in which you rebalance your portfolio, responding to market shocks. Okay, so if you end up having more exposure to the equity market in good times, you tend to have larger returns. And basically, what you see here is that after the robo, people who had low return to start with tend to have a larger increase in return. People who are older tend to have a lower increase in return. People who are female tend to have a lower increase in return. And people who are wealthier tend to have a lower increase in returns. So this is the total effect. And again, we want to try to distinguish between a direct impact of what happens at take-up and an indirect impact of what happens due to difference in rebalancing over time. Okay? How people respond to the alert that the robo is sending, for example. And so the way we do it, this is sort of not an easy exercise to do, because you have to construct counterfactual rebalancing decision. So you could say, if people didn't have the robo, what they would have done when there is market shock? Would they have, there's a negative market shock, would they have start to, run away from the market and put all their money in cash, or would they be contrarian and put more money in equity? So the way we do it is to because we know exactly the way in which the robo works, we can do the following. We take the people who are given a suggestion from the robo that is very close to their current allocation. So they go and they look at they do the questionnaire of the robo, and the robo is telling them, oh, you should invest 50% in equity. And suppose that they already had something close to 50%, and then they decide not to take the robo. So these are people we call robo-curious. So they are curious because they went and see the robo, They didn't take it, but we call it curious close, because they start from they would have started from a very close position to what they had already. So these people, if they had taken the robo, they would have changed only what happens after the take-up. They would have not had any change at take-up, but just in the rebalancing. And so if you look at the change in returns compared to these people, you can see what is the impact of the behavioral response of the investor to the robo. And essentially what you find is that, going very fast now, but for people who have experienced the most gain in terms of returns from the robo, those are also the category of investor who, for which this change in rebalancing is the most important. So if you want to explain, for example, the increase in returns for those who had low returns to start with, 80% of the increase in return is driven by the way in which they change the rebalancing of their portfolio. And then you can do the same across different characteristics. Okay, because I don't have so much time, I want to skip things and tell you what happens. The last thing I want to say is the following exercise. What happens, so suppose that we are concerned, I'm making a lot of hypotheses here, but bear with me. Suppose that we are concerned that the robo is creating inequality across gender that are somewhat artificial, okay? So remember, we start from a situation in which men and women are pretty similar, both in terms of returns and equity exposure, and after the robo, we end up in a situation in which women have less equity because the robo tells them to bear less equity, and they have lower returns. And so let's suppose to design a robo which corrects for this bias, where both correct and bias, you see, are pretty loose terms, but suppose these are a bias we want to correct. So for example, the robo what would do would be to condition his recommendation on gender. Say, okay, as a woman, you tend to underreport your risk tolerance. Let me give you a little bit more equity than if you ask the same thing and you are a man. So what we do is sample the distribution of women and men to make them similar in terms of risk attitude. And so what you find is that essentially the equity exposure that they have after having taken up the robo becomes very similar. Okay? Meaning, confirming the previous result that essentially these differences are driven by the way in which the robo is profiling them in terms of risk. But now if you look at the return, you still have significant difference between men and women, meaning that here is not enough to correct the bias of the robo at the time of take-up. It's also sort of important, it would have been important if you want to equalize return to make them respond in the same way, to make men and women respond the same way to this alert that the robo is giving to the investor. Okay, I'm really out of time. I know Catherine is tough, so let me conclude here.
Thank you very much, Milo. So I suggest that we skip the questions for after the discussion and we move directly to algorithmic transparency and portfolio choices presented by Béatrice Bouluret-Chef. Béatrice, you will have 20 minutes as well.
Hello, hi everyone. So I'm presenting, but Mehdi, who just graduated, was my PhD student. He called sick, so he was supposed to be the one presenting. So in 2 years, he's going to be available for jobs because he's doing a postdoc. Okay, so the paper is called Algorithmic Transparency and Portfolio Choices, Field Evidence. So we ran an experiment with a fintech trying to see what is the impact of transparency on portfolio choices. So if you look at the regulation, MiFID requires that firms that give investment advice, they need to spell out the basis for that advice. And so in the context, of course, of fintechs and robo-advisors, it's a complex exercise to do because you don't have the human interaction and there's always a chance that people skip the information very quickly. Now there is another piece of information from a regulatory standpoint. It's the new AI Act that indeed requires firms to give enough information about high risk, what's called high risk AI systems, and they need to give a clear explanation for actually the advice that they have given. So it's very important in the context of finance. And so this is the reason why we decided to run the field experiments within a fintech to see whether the provision of an explanation is going to shift behavior. And here, so think about robo-advisors. I mean, you all know what it is, just as a clear note. So this is self-administered questionnaires that people do within the tunnel, what we call the tunnel. So this long questionnaire where you give information about your social demographic information, also your economic situation, and then you get an advice. And normally, I mean, as all advisors do, you can just choose this recommendation of a risk profile, or you can modify it. But rarely, investors in all of this, online recommended systems, they get information about actually what generated the advice. So then there's the second literature on what's called XAI, so it stands for Explainable AI, artificial intelligence. So there's this whole literature that looks at automated algorithmic system and artificial intelligence and how to get those systems to actually provide an advice that's going to be intelligible for people. And what they're really interested in is those two things. So they say we need to clarify the drivers of individual or aggregate predictions. And we need to support understanding, acceptance, right? I mean, Marie and Milo, they have worked on trust, so we're going to cite later. So it's a very large field in AI systems on these two questions. So robo-advisors, what do they do? Essentially, they drive down costs. We know that. So it's, in some ways an opportunity indeed to reduce inequality, as you were just saying, because you can get access to equity and financial investments. And also there is room for potentially reducing human biases, although those women, they do get a lower score. So it's interesting. But this efficiency, it comes with a trade-off. The first one is clearly the loss of personal interaction, and there's this black box or opacity to the score that has been generated. So this has been studied mainly here. I was talking about Milo and Marie, so their work on the role of trust for financial delegation. There's been also lots of experimental laboratory experiments on this question, and there is some evidence of the importance of the role of trust. And also there is some evidence, but very limited, on the impact of providing explanation. And essentially there are three types of explanation. There's accuracy-based, feature-based, or performance-based in the context of financial advice. So I'm going to tell you what we did in this experiment. The main research question that we ask is, do profile-based explanations. So we provide explanation about the profiles that the fintech is recommending. Here is going to be the concise disclosure of the drivers of a recommended risk score benchmark for similar users. So if I get a profile 9, this is the average features of the people who got this recommendation, okay? Because you don't say the algorithm generated this, we said the people who received this recommendation had those characteristics. And we see whether it increases the acceptance of algorithmic risk profile recommendation. So we work with the leading French robo-advisor platform. We implemented the field experiments within their onboarding tunnel. So as I said, our explanation strategy was derived from the robo-advisor's underlying financial algorithm. And so we had two conditions, a simple one, so a control group with no information and a control group with an explanation. And so we have 4,000, a bit more, 5,000 contracts. And we have fewer unique users because many people open several contracts. Okay, so this very simple onboarding tunnel. So there is the random treatment assignment via the user ID. They do the financial questionnaire. Some of them go to the control, so they don't get an explanation and they validate the profile. So not getting the explanation was the way it was done before, right? So, but they were very happy to implement that because MiFID does require the provision of an explanation. And so the other people will get the treated, and then there are the legal documents in which we can get information about age, gender, all these things. Okay, so the response from the financial questionnaire is weighted via a defined system. That's their algorithm. and it reflects some attributes. So essentially it takes into account the liquidity constraints, the risk preferences, the economic characteristics, the investment horizon, and the financial knowledge and experience. And so the platform required a no-code solution, so it had to be something that does not weigh a person's characteristic. It had to be something that is for this risk profile. This is why we decided to also show this implementation. So the way it worked is that if you are attributed a risk profile, risk score of 9, for example, you're given information about the average characteristics to be attributed to this specific class. So that's the average user within this profile, okay? And so here's the thing, which is because maybe the average user, I'm not that close on some dimensions to this average user, right? I may be somewhat, distant. And so that's both a feature-based and also social-based because there are peer group characteristics, right, that can be inferred. So this is how it works. This is the baseline, and this is the recommendation, where the explanation is indeed, you see on this ladder, there is information provided on whether they are, more conservative, more dynamic, right, on all of these aspects. So this is how a user within this profile, how these characteristics are weighted. Okay, so 105 days, these are the contracts. So the average age is conventional for fintech. It's not that young, but it's a bit younger. These are people also with reasonable income. And there is some diversity also, just like in it's interesting because there is enough diversity in the financial knowledge. Okay, so just the balance check for the recommended risk, so we're fine. And on level 8, there is a very small diversion, but essentially between the treated and untreated, the random assignment did the job. And these are the different risk profiles that they can get. So the lower the score, it's a nice fintech because the lower the score, the lower the stock ETFs, the lower the equity, also the bond, it goes up and then it goes down, right? So it's a very simple characterization. Even for someone who doesn't have a lot of financial literacy, you do see that risk profile 2 entails less risk than risk profile 10, right? So it's a relatively simple presentation. It's not something that actually people can understand, right? Okay, so an interesting part of our experiment is that we have people on computers and people on phones or tablets. And so you see here that the distribution happened to be relatively well distributed, right? So these are for the not treated and the treated. You see there are a little bit more people on the phone, but not as much. And the interesting part that we get is that we get the returning users and also the first-time users. So the returning users are users for which we have their ID within the period of the field experiment. So these are people who either decided to, have some deliberative time and they didn't make the decision right away, came back and then finally signed the contract, or these are people who signed an initial contract and then signed another one, okay? So these are people for whom, they had to think about it, or maybe they had to go to, to do something else, right? But indeed, there was this period of time. Okay, so outcome variables, so we look at acceptance of the SCOR recommendation. It's 1 if they accept the one that was recommended, 0 otherwise. And then we have deviation measures from the recommended score. So there is the first one, which is whether the chosen risk profile is different and higher or lower than the recommended one. And also we have another one, which is we just look at the size of the deviation, whether it's negative or positive, right? So we just split the data into the ones that decided to deviate downwards and the one that decided to deviate upwards. So there is no statistical difference in the acceptance rate. So providing this information does not change, the user's propensity to accept the recommendation. And in fact, they have an almost identical pattern. So it's fantastic. I mean, it's mind-blowing. You'll see the graph. So essentially, the acceptance rate ranges between 80 and 90% for the risk profile 2 to 6, and for 10. And for the profiles in between, you'll see here, for the profile, 7, 8, and 9, here they move a lot, these people, right? So, but the one at 10, they stay there. The one below, they actually, 80% of them accept the recommendation. And the one that are between, 7, 8, 9, they tend to move more.
Sorry? When
yeah.
you do not
No, they just choose another risk profile. Yeah. They don't accept the recommendation, they modify it, exactly. So the regulation analysis for all, we have all the possible controls. So this is, we cluster at the ID level because some people have several contracts, and we really control for age, type of investment, everything, also the recommended risk profile. And so this is what we see. Indeed, as I was telling you, the treatment does not have an impact on the acceptance of recommendation, but the phone does, right? People who do it on the phone, boom, boom, they accept the recommendation. They have a very strong propensity to actually do so. And the first-time users also do it. So there is a population of people on their phone who decide to invest thousands of euros, click, click, like that, okay? So now the deviation, so we have about 54%, right, of our sample we deviate. There are more positive deviations than negative deviations. And you get this similar pattern of deviation as I was telling you. What we see is two things. The deviation of +1 and +2, typically, they dominate in the mid-range recommendation 3 to 7. Okay, so the people who deviate in this mid-range, they go up. There is a substantial fraction of users recommended 7 to 9 who actually go to 10, right, directly. So those are people who wanted the equity. And there is negative deviation, relatively rare in the mid-range recommendation, but they become more prevalent for people who get 10. People who get 10 sometimes deviate down, okay? So this is how it looks like. This is the baseline, this is the control. And so you see there is really no difference, right? I mean, it's spectacular how similar it is. Okay, so this is for the deviation. As I was telling you, no difference whatsoever. So this is the first measure of deviation, which is this absolute measure. Now there is the positive deviation, also no difference whatsoever, but interestingly, for the negative deviation, there is something that pops up here, which is for the treated, indeed, there is, so the people who, here the measure is the people who deviate down, they deviate a bit more when they are provided with any information. And interestingly, if you just look at the computer, it's in fact driven by the computer people. So if you are somewhat interested in deviating down, I provide you with information about your risk profile and the other risk profile that are around, then those people, when they are provided with information, they are more likely to go more down. And so when we look at it to say, all right, so those who were seeking the information indeed looked at the information, and the only ones who could really move were the ones who moved with the explanation. But interestingly, you see with the first-time users, it does not completely make the impact disappear, but it does mitigate it. So it's driven by the people, the returning users, on the computers, right? So the people who think. Okay, so just very quickly, how much time do I have? 5 minutes, okay, so I'm good. Some additional results, and we're actually working more now on the time of, that they spend on the interface. Here we look at the engagement outcomes, the opening events and modification events. So the engagement outcome, that's what we find overall is that when you take engagement metrics, there is no additional effect, right? There is no effect of the treatment, so providing people with this information with an explanation of what the algorithm did, it does not change their behavior, okay? So what we look at is the total attempts, so that's the number of times they completed the tunnel, the opening events, so the number of times that they clicked on the open modification interface. I'll show you the interface in a second. And then the modification event is when they actually adjusted their risk profile. So this is the opening event. So I look at the information about the profile here, so it's 9, the dynamic, and I look at it, and the modification is that I choose another risk profile, okay? I actually make the effort to do that. So on the total attempt, the first-time users are way more likely to do the tunnel several times, so they're trying to optimize the algorithm, right? It's something that you can see. They are, interestingly, for the opening event, so you see there is a small, very small effect, 10% of the treatment, which means that the people who actually open the interface, when there is the explanation, they are more likely to do so, right, which makes sense, but it doesn't change their behavior in the end compared to the baseline, and also on the phone, they are much less likely to do it. So there is something related to being on a computer, looking at the information, I think on the phone is just very hard to do so. And then the modification event, same thing, you get this effect that people on computers are much more likely to engage with the interface. So we did some machine learning to look at, conditional average treatment effects. So essentially, we don't get anything that's very interesting. But from my perspective, I'm a lab experimentalist mainly. If you don't get simple statistical effect, you should not run an additional machine learning. But we did it to actually, have a look. And one of the things that we see is that there is some interesting heterogeneity with respect to project objective. So this is the only, subsample characteristic that does pick some variation, so we're working a bit more on this, but again, this limited heterogeneity, and if you really slice down the data, you do end up with very few observations, so we should not pay too much attention to this. So the main results, as I was saying, so we do not support the widely anticipated adherence gain from increased transparency. There is a huge literature out there in extendable AI which says that it's very important that this is really going to make AI acceptable. What we see is that they don't pay much attention to it, and the ones who pay attention to it are the ones who were, returning users, and they understand the risk, and they think about it, and they use the information. So it's important for a small subset of the population. So we see that the behavior is primarily shaped by the context and the platform experience. So the mobile and first-time users, they follow the recommendation more often. And the desktop and returning users, they tend to deviate more, okay? Which makes sense, but the results are very strong. And the third explanation is that, explanation did that leads users to expose more by redoing the onboarding process or investigating the alternative portfolio. What we see, as you've seen in the regressions, that the mobile users, they were more likely to accept the initial recommendation with minimal exploration. And the platforming experience is linked to more active behavior in all three measures. So it's a relatively large-scale field experiment on this algorithmic transparency. It does show that the profile-based transparency intervention has no impact on recommendation acceptance, on deviations, or user engagement. And interestingly, it contradicts the prior lab features, right? I was saying I ran experiments, but not on these questions. For this question, I actually go to the field. Because I think we do have to see real people with real money and real horizon and real kids, and right, so there is a huge, scientific interest in actually getting field data on this. And is it good news for industrial, from an industrial perspective? Probably, yeah, because it means that even if some AI-supported systems don't provide the explanation here, we see that actually, it didn't change behavior. So from a regulatory perspective, I think it's reassuring. And future research, we want to work more on attention measures. So we're working on it right now, looking at click logs, time on task. It's very hard to actually work with time data. We're also looking a bit more on this machine learning work on segmenting investors and trying to see whether motives change their relationship with the explanation. We should also look at long-term effect, looking at whether this transparency impacts behavior over the long run. And finally, the last work is going to be on the cost of deliberation. We're trying to see whether providing an explanation does increase the cost of deliberation. Is it harder for me to decide if I'm providing with an explanation, or there is no deliberation cost associated with actually this provision of additional information. Thank you.
Thank you very much. And now Laurent Bach from ESSEC will discuss both papers. You have 15 minutes max.
So, okay, well, thank you very much for inviting me to discuss two papers. It's pretty unusual, but it's also pretty nice because there are obviously connections. At least I try to build connections between these two papers, and you will tell me whether that's a success. Yes, perfect. So So these are two papers on robo-advising. Usually when I discuss a paper, I try to provide descriptive statistics, time series about phenomenon we discuss, but to be honest, there is just almost nothing. I mean, you hear about assets under management, and they seem to have reached $2 trillion, but whatever that means. The thing is, it seems to be exploding, at least if you believe in the industry news. What is the aim of robo-advising? Well, at the end, it's not just meant to improve profits of asset managers, but also to improve welfare by making allocations of households closer to their preferences. And there is certainly scope for that, because the literature so far, the empirical literature, has looked at how portfolios deviate across the population, and they deviate a lot across people, much more than preferences are different across people. So there is much more portfolio heterogeneity than there is preference heterogeneity. And it's important because if actually robo-advising delivers on its promise, it means that robo-advising may reduce those portfolio inequalities and at the same time improve welfare at an individual level. So it delivers on both efficiency and fairness. The problem with this story is obviously that, well, these two papers are essentially showing that, well, the problem is that robo-advising, many people don't take it up. They don't take up the advice that is provided by the robo. And as a result, the effects on welfare inequality of robo-advising may not be the ones we expected in the first place. That's the paper by Milo and Marie. And then the second question that one can open is how we can improve the take-up. I mean, that's not exactly how you pitched it, but that's the way I'm doing it. But essentially, what are the ways in which we can change the platform in order to improve the take-up by households of robo-advice? So I will, in what you see, I will name the two papers by the initials of their authors. I apologize for that, but and I'm now going to mention first, what are the challenges that these papers faced. So first of all, I mentioned it already. There is just absolutely no data at an individual level on robo-advising and how households react to robo-advising. And both papers are providing us with lots of super important numbers based on specific envelopes, obviously. The first paper is on employer-sponsored saving plans. The second is on life insurance, but nevertheless, that's super important because you have access to actual individual account management data. And then a second problem is how do you identify the specific effects of robo-advising as opposed to other potential effects? So the first paper is doing this by comparing between robo-takers and robo-curious, those who have showed some curiosity, but in the end they chose not to take it. And then the second paper is obviously doing a field experiment, which is this is the gold standard. So this is really a great improvement. The results are a bit ambiguous. I would say. The first paper says that, okay, robo-advising increases low-risky shares, at least for those who started initially with fairly prudent allocations. But it does not work so well for everybody, and in particular not for women, probably because they seem not to maybe trust the platform as much, or maybe, I mean, I'll discuss that, maybe they just don't like the recommendations that they are given. And as a result, the gap in returns, which should have declined across the population, it in fact increases at least between men and women. So the effect on inequalities is good on some dimensions, but bad on other dimensions. And the second paper, well, essentially says that well, all those attempts at improving take-up, they don't seem to work so well, at least if we focus on one particular attempt. This graphical design experiment does not seem to have made a difference. Now, I have essentially three classes of comments. The first one is, okay, is it a problem about the household facing the robot or about the design of the robot? From the papers, and I think, you know, it's by nature of the algorithm, it's not always clear what is the model that is actually used. At least as economists, we have lots of asset allocation theories, we have lots of models and so on, but clearly the robots do not read the literature, and that's all right. But the problem is that we don't really know exactly how they work, how they map the preferences, the questions that you fill in into actual allocations, and there must be a model. So in the presentation Milo presented, like some form of reduced form explanation of what is proposed, but at the end, since we don't really know exactly how it works, we cannot be sure that the robot is delivering what it should, at least according to economic theories, to economic predictions. And that could be particularly problematic if it happens that the robot takers, the ones who like the robots most, are less financially literate, or if they are less happy with banks in the first place. So I didn't mention it, but the only micro data I could find on robo-advice across households in Europe is coming from Italy. There's a nice survey that was published in 2023, and what you see is that indeed robo-takers, they don't trust banks. They trust banks much less than the rest of the population. They are indeed a bit less financially literate, but quite confident about their abilities. They might have very weird preferences. And as a result, it's not clear that the model that is coming from the robot corresponds truly to what these people really need, let alone want. So that applies in particular maybe to women. Maybe women are led to overestimating the risk tolerance on the platform, and then when they see the actual allocation, they're like, that's not really my thing. So it could be that effectively the mapping from risk tolerance to allocation appears to be not good enough for them. I also had questions about those alerts in the dynamics, because it's super important to see that it seems like a large part of the long-run effect is coming from the fact that households are led to rebalancing their portfolios so as to keep their target risky share well in accordance with their preferences. That's great, but what I was curious about is essentially you see them deviate from the target risky share. Well, not deviate from the target risky share, but the question is, did they agree in the first place with their initial risky share, or are they just reacting differently, inconsistently between what they said in the first place and what they said afterwards? That will be interesting to compare. And then I was curious about this focus of the paper on increasing returns, increasing risky shares, and it looks as if nobody is having an actual share higher than the target that's proposed by the robot. Maybe that's because the clients of the robot are particularly prudent, but it would be good to mention at least how many there must be at least some people whose actual risky share was higher than the target proposed by the robot, and I was curious about this. For the second paper, there is also something about the design of a robot. I mean, there is this thing which was very weird to me, is the fact that the acceptance rate is so low for risk profiles between 7 and 9, it looks as if those categories are too ambiguous. In a sense, people either are 5s and 6 or they are 10s, but they are not 7, 8, and 9. And the problem is that the robo is giving lots of 7, 8, and 9. So that looks as if there is an issue with the robo. And in particular, because you see that most of these people are effectively deviate towards a 10 allocation. So it looks as if the robo is a bit problematic here. I was also curious that's something that we see in the first paper that we don't see in the second paper, is a view of how the acceptance rates deviate across household characteristics, across financial literacy. Is the fact that is the lack of acceptance correlated with the lack of financial sophistication? And more generally, it's a cheap comment, I'm sorry, but it's true that the graphical treatment is not super impressive. When you look at it, you're not like, wow, people must be wowed by this experiment. It could be that many just didn't realize that something was going on. And if you pair this with the size of the experiment, I'd be curious about the statistical power test. Maybe you did that, but I'd be curious to know what was the minimum detectable effect of the experiment, and is this something credible given the design that you had? I think that would be important to mention. I think it's great to show null effects in any case. I love null effects, but it's important to pair them with power computations. I don't know how much time I have. 2 minutes. Okay. So then there is the effect of a market context. All these robots came up in a period where stock markets were booming. And it's still not completely clear what will happen in very bad times. And there will be some bad times. There have been some bad times, actually, in 2018 and 2022, somewhat. But these papers are focusing on longer periods. We don't really know about the second paper when it was implemented. That's, I guess that's part of the contract you have with the online platform. But it would have been nice to know whether it was in a bad period, in a good period. I think it was in a good period because the last 10 years were essentially a good period. And for the first paper, the problem is that there is an emphasis on returns, which is problematic because in a very good period, obviously, when you have an increase in risky shares, you obviously have an increase in returns. But in bad times, there will be, for the same people, a decline in returns. So I would prefer to see, that's a personal taste, but I would prefer to see betas and alphas. And I think there won't be that much alpha. So it will be mostly a beta effect, rather than a return effect, which is a bit difficult to interpret. And then the dynamic effect, it should be investigated. It could be investigated further. I felt maybe those close curious are close a bit by chance in 2017. Would be important to check that whether the people that are close curious would have been close curious in 2016, in 2015, in 2014 to have really structural close curious. And finally, well, I think that it's unclear whether we can isolate the effect of the fact of taking up robo-advice with the fact of taking up fintech in general. Precisely in Italy, in this survey, I could find that robo-advising is extremely correlated with other types of take-up of fintechs, in particular of online banking or Apple Pay. So there is a super strong correlation in Italy with robo-advice and Apple Pay. And you think, they are not so correlated, but it makes it hard to judge whether what we see, whether the practice of taking up robo-advice is not just correlated with a general appetite for fintech, which is obviously a very selected kind of person. So I have all sorts of things about selection here that I won't mention. Thank you.
Thank you very much, Laurent. Before giving back the mic to our two speakers, I'd like to see if there is one or two additional questions. Does anybody have a question on these first two papers? So then, Milo and Beatrice, do you have a word for Laurent? Or it's fine if you don't.
No, I do. I do thank Laurent. These were super good comments. So two small details and then one bigger. On the rebalancing and the target, investors did agree on the target. That's why they took up the robo. And then what the robo is doing is to try them to let them stick to this target. And this is not obvious, especially in bad times when it's supposed that you have agreed with the robo to keep a 50-50 allocation, 50% equity. The market is crashing. The robo is telling you should put more money in equity now. So if you are not Warren Buffett, this is difficult also psychologically to understand and to do. And so indeed, we in a previous paper with Marie, we do show that people find it harder to follow this recommendation in bear times. So there's not much effect on returns, but it's just difficult to follow this recommendation when the market is going badly. The second point, the second question was, indeed, on average, people are increasing their equity exposure thanks to the robo, or thanks to following the robo, but not everybody is doing that, and especially we see older people tend to, the robo tend to recommend older people to decrease their equity exposure because of an horizon effect. Older people declare lower horizon, and so the robo tells them you should decrease your equity, and maybe we should analyze a bit more this heterogeneity. And the last point, which is broader, I think I take very much this point of understanding, what comes from the design of the robo, what is the underlying model, and should we discuss that? Is this a right model for everybody or not? Versus what is the effect of household response? And so we certainly try to develop this more. But thanks. And
yes, I'm taking back the mic. Beatrice, you want to say a word?
Yeah, thank you very much for those excellent comments. So maybe also 2 points. The first one, does the robo do something really funny and ambiguous from risk profile 7, 8, 9? Yes, for sure. Most robos do, 3 profiles, and here you have, 2 to 10. So there's a lot of room for ambiguity. And maybe we should not, we should create, buckets actually, and look at whether people, how they behave within buckets that make sense. So that's a very good comment. And on the heterogeneity and the treatment, yeah, I mean, it needs to be a treatment that conveys an explanation on something that's very complicated, and it needs to fit on the phone. So, right, so that is almost an impossibility theorem. And so we worked a lot with them to try to actually, provide an explanation that is, in which there is no deception, there is no lying. And that makes sense, and that's going to lead to people so they understand, what are the differences between profile 2, 3, 4, 5, 6, right? And so yeah, this is very hard. And clearly, I buy the argument on the heterogeneity. We have some crazy people, right? The people on the phones, they come in, boom, 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 they invest. So these Apple Pay, these Italian guys that you have in your survey, they are in my field. and so, yeah, so this heterogeneity needs to be better documented. I agree that we should probably interact with treatment with, more information also that we use as controls, and just put them up and see whether there is heterogeneity in, financial literacy and experience that explains a bit more the treatment. Thank you.
Thank you very much, Beatrice. We are going to move to the rest of the session. There seems to be crazy people on the phone in the room as well, so please turn off your turn off your phones, or at least mute them. Our next speaker is Roman Matkowski, who will talk about financial advice behavior, humans versus AI. So again, you will have 20 minutes.
Hello, everybody. First of all, thank you for having me here. 1, 2, 3, yeah. Thank you for having me here, and thank you so much for staying for the presentation. So I'll be presenting one part of our large research project on AI versus humans. And particularly we focus on financial advice, professional financial advice, I would say. We have a control group of students to compare, but the focus is on the professional financial advisors for very rich people. This is the context. So, we know that financial advice is pretty much costly, and not everyone can afford this. On the other hand, we all know that it's been more than 40 years of research saying that human beings are quite biased. So rational part versus noise, and noise sometimes dominates. So we project ourselves to other people. So the question was, okay, if, for instance, people are biased, people suggest mainly what they have dealt with, possibly we can deal somehow having AI in our pocket. Given that AI systems are now developing at the speed of light, we all have either Gemini or ChatGPT or Claude in our pocket, potentially it might address the current issues. So the other aspect is that potentially it will help people to be more involved into investment activities. So we have that millionaires control roughly 48% of the global wealth, and 40% of them use financial advice. On the other hand, we have only 33% of general population coming to have this advice. And AI might be promising. So we are intending to compare how AI systems of different caliber, of different providers, can be compared with professional human advisors. So, what do we know so far? Again, human advisors bias. We have several research documented that client recommendation mirror advice can be quite significant. We do not know the precise structure of this projection, but it is documented that it exists. We have gender issues in advice. We have that women are less represented, they are treated. We have this perception of women differently than perception of men. On the other hand, we also have some research that documents that AI is not without problems. It can be also biased. It can also play with stereotypes. And all the models, actually, they provide this evidence that the AI per se can be biased itself. And we have, had the possibility to listen to this today. We have Robo-Advice and portfolios. We have also rich research on this topic. That Robo-Advice offers cheap, less volatile advice, sometimes tempers cultural biases, that financial literacy to monitor advice activities is conducted to portfolio returns, etc., etc. But so far, to the best of our knowledge, there wasn't any study on the comparison precisely human beings being asked some set of questions versus AI doing the same things. So here is some research gaps. Structure of the projection, how much is really transmitted from advisor to a client. It is quite unknown still whether AI as financial advisor inherit human financial bias, or possibly it has internal different types of biasness. And we do not have a clear picture so far what if we change the prompts for AI? So prompts are now kind of a high-level programming language for AI. So how changing the prompt system, we can get different results from it. And finally, how much does it cost for clients to switch from humans to AI? Yeah, so we are roughly asking these questions. So we have several parts of the research. First, we want to quantify how much we project. Second, how much AI can project of human biasness, or how much it can project of internal biasness. Third, how much we have degrees of freedom in terms of prompts. And yeah, finally, monetary expression of this story. So, what we contribute, hopefully. So we have that we quantify the projection, the clear projection from humans to clients, to both real clients and fictional clients. We documented LM distortions. We documented high heterogeneity across different AI systems. We show that prompt scribing is not monotone debiasing. So prompts, the same prompts can have opposite effects in different AIs. We slightly compared with Robo-Advice, that LMs is not the same as Robo-Advice. We have probabilistic inference, and bias attenuation benefits do not transfer. And finally, we quantify the loss and benefits for clients for both categories of advisors. I should have said it before. The presentations slightly differ from the paper that it was submitted. Yeah, we receive a kind R&R. So the difference is just in terms of how many AI models are being used. Now it's extended to 9, and actually that's it. So, how we conduct our experiment. So we created 10 fictional, we created 10 vignettes with fictional clients. We have age, gender, net worth, income, spending. We created 7 types of portfolio recommendations, and we had 4 different measurements per vignette. What they are: it's portfolio recommendation, it's perceived knowledge, perceived control of a situation, perceived riskiness, and we have human advisors. Human advisors are real 190 professional advisors from European private banks, the ones who serve, again, very wealthy clients. And we have also 114 students as a benchmark. We call them unprofessional advisors. And then we deploy several AI. So we started with GPT-4.0 and Gemini 2 last year. We considered them as a baseline. And then we extended it with 7 additional models for robustness. So we tried to catch the evolution of the model. Also, we tried to catch the differences between providers. So we have Google, we have OpenAI, and we have Anthropic. And we have different types of models per se. We use biased and unbiased prompts. What is the difference here? Biased prompt is composed with the whole demographics of real clients. So we said, you are a financial advisor, and then we plugged all the characteristics of real 190 professional advisors. Age, gender, number of clients, marital status, children, education, all the demographics, plus professional life. And after this, we plugged a vignette. So vignette, the example of vignette is here. So we have some client, also it's his demographics or her demographics, and have question that should be solved. In unbiased prompt, we didn't include the information about real professional advisors. We just plugged the sample vignette, asking for the recommendation. So here are the portfolios. We follow the PIMFA benchmarks. PIMFA is one of the most reputable UK association. So we have 7 different types of portfolios, which differ in terms of riskiness. So the number of equities increases, percentage of bonds decreases, and we have cash, commercial property, hedge funds, and yeah. So the higher the tier, the higher riskiness of the portfolios. So what we have? We have, again, 190 advisors. Average age is 39 years old, 11 years and a half of average experience, 39 clients on average. Average asset under management is more than $500,000. And we have the gender inequality as in financial service, 77% of males and 23% of female financial advisors. So we have advisors' personal portfolio composition. So the letter A means advisors, C stays for client. So we have structure of the individual portfolios of each advisor in terms of equities, fixed income, cash, property, alternatives, and based on these counterparts, we also created the risk index, because in the empirical part, first we focus on equities, then on fixed income, and then to prevent plugging these other parts, we created the aggregated index with all of them. And then based on vignettes, we have, and based on real client information, we have the equities, fixed income, cash, and risk index as well. So we have that 41% equity for advisors in their portfolios versus 28% of equities in clients. So clients hold more fixed income and cash, relatively to financial advisors again. Then we have client, fictional clients. So we mark them with V. This information comes from vignettes. And so we have gender, net worth, income, outgoing, so what is the spending pressure of the fictional client. We have the investment amount, recommended portfolio, perceived control. So we asked financial advisors, how much do you think a client has control over investment, over situation? And we ask, how much do you think a client tolerate risk versus average investor? So it's risk tolerance. And the knowledge is, how much do you think your client is knowledgeable related to the average advisor? To the average client, sorry. So, vignettes shows typically wealthy investment clients again, and portfolio recommendations correlate mostly with the perceived risk tolerance and negatively with age. So these are our models. So we have from OpenAI, we have ChatGPT 3.5, 40 Mini 5.2 with and without reasoning. From Google, we took 2.0 and Gemini 3. That time we were the last one. And from Anthropic, Haiku and Sonnet 4.5. So methodology. We have many questions. So 5 minutes. Oh God. Sorry. Methodology again. Many models tailored for each of the questions, and I will skip it. So the first results. Yeah, gender has always negative effect on equities. Age has positive effect, typically in all models. Risk has positive effect on the personal allocation. So confidence is very interesting. We interacted confidence with many variables. So the effect of confidence is not linear. So it's positive when you are slightly confident, and it's very positive when you are very confident, especially when it is interacted with the experience. In terms of fixed income, yeah, we have similar picture. Gender again negative, age positive, some other covariates not very strong, and yeah, this is how individual portfolios are created. So projection, yes, people project themselves. So we quantify that one standard deviation changes in personal equities, in personal fixed income, and overall composition of the portfolio is transmitted significantly to clients. So 34 standard deviation for equities, 27 for fixed income, and 24 percent points for average index. Yeah, so women set safer baseline, but it's interesting. Both genders project. Women are safer, but when they project more than men. So then we compare, so we have the picture of what are the factors that affect individual portfolios, then how individual portfolios are transmitted to clients, and then we compare it versus AI. This is the baseline, and we see that in the baseline, all AIs are less risky in terms of recommendation. So humans are the riskiest in their advices. So here we have all the models and compared versus humans. So we have that ChatGPT 5.2 no reasoning is the closest to humans in terms of riskiness, risk recommendation for clients. And yeah, riskier are all models from Claude, and Turbo GPT 3.5, it's not statistically reliable result. It behaves very unpredictably. It's very crazy. So then we compare it again. We run many tests to compare how AI recommendations go along with human recommendations. Again, it's to show you that we have data between humans and AI, we have control risk and knowledge. The question was, if AI recommends less risky portfolios, possibly it also judge people differently? Sometimes yes. So in terms of control and risk tolerance, yes, true, it goes in line. But in terms of knowledge, AI goes all over the place. So recommending less risky portfolios, it doesn't go with the judgment that humans are less knowledgeable. So we have a battery of robustness tests. So again, it's sorted by the distribution similarity. Again, GPT 5.2, no reasoning, unbiased, is the closest to humans in our setup. Okay, I will skip it. We have the next models are how AI is sensitive to prompts. How changing the prompts from biasness not to biasness doesn't make any changes. Yes, it makes. So we have so Gemini model shows significant overprojection. So if you plug into AI that you are advisor, whatever characteristics, it transmits this biasness to clients. So Gemini is top in this. All Claude models are not. Yes, here you have the summary of the asymmetric prompt effect. So for some models like ChatGPT 4, biasness can, or unbiasedness can narrow the gaps. For Gemini, it's opposite. So it links with the fairness through unawareness hypothesis. If you don't know something, you cannot be biased, but it doesn't work. Okay, I can skip. It's similar. Yeah, so here we have. So red models, severe compression. So typically AI provides less variation in recommendation with huge compression. So mainly AI recommends something that goes to the middle. So we have this gray. We have compression just. Green ones are very similar to people. So near alignment with people, it's Sonnet, GPT-5 and again Sonnet, yeah. And the bottom is recommend riskier and more variable than human. Okay. Now, how much does it cost? Sorry? Yeah, I'm coming to this. Yeah. So, how much it costs? We have that over 20 years, it can cost 41,000 for investment loss for humans if to go for AI. But if you include fees, most AI outperform humans. So break-even is 1.03 annual %, standard, pretty much standard for the financial advice in the industry. Yes, so human project is huge and significant. AI calibration distortion are model and configuration specific, so huge heterogeneity with some changes for the newest model compared to the older ones. Prompt effects are asymmetric to model specification, and the economic consequences are substantial but fee sensitive. Thank you so much.
Thank you very much. So as before, we'll have the second speaker and the discussion at the end. And so Romain Perchet will present multi-asset portfolios with active and passive funds. So Romain, you have 20 minutes as well.
Yeah. So thank you for the invitation. I present the paper written with my colleague Ala Malouli in the room and for other people from BNP Paribas Asset Management. The goal of this paper is to propose a framework to move from a strategic asset allocation defined in asset class, which is the most use case presented to end client, into an investable portfolio with fund, which is a way to invest in practice. In this framework, we want to combine active and passive fund, which is when we see requests from clients, we could have pressure on the fees, but we have also a request from personalization, which is typically adding sustainable investment in their allocation. We could the mix is also a request from portfolio manager who wants from some asset classes have a native based rather than from other parts. They want to have active fund to more take specificity of market. And this framework is a way for us to answer to fee pressures that we get today. As I say, more personalization we have from the portfolio for client, and we have pressure from outside in the industry. And this could be addressed, this framework, for robo-advisors or retail investor, or for also institutional for more multi-asset fund and fund of fund. I would say this framework is a one-step process based on an optimization. We are working in tracking error aversion, so where we have defined the strategic asset allocation in asset class, rather than we want to invest the active portfolio is defined with only fund. And with this process, we will take into account all the constraints that we could get, and which is key that in the process, the active return of Markowitz will have two components. The first one is that we will define as a practice of the market a pure unconstrained portfolio based on the market conviction of PM that could clearly an active portfolio where PM could be very long on the US market, short on the sovereign bond or whatever you want, which will be practice a pure unconstrained active portfolio. The other component of the active return used in the optimization will be the alpha of the fund. And when we say alpha of the fund, will be the net active outperformance they could get, net of the fees of the fund. And in this active return, which is mu, we have a gamma, which is a way to manage the aversion of, or the way to drive active fund versus passive fund, which is the framework that we want to present today. And based on that, we will run an optimization in one step for hand. We will have strategic asset allocation defined with an investable portfolio and with adding funds that we get. Which is also key for us is that this framework is not based on Markowitz optimization, but more on robust optimization, which is adding uncertainty on the return, which is clearly a key component for us to stabilize an optimization and to make more trust in optimization rather that could be used in traditional framework, which could be more a rule-based portfolio. We prefer to use an optimization to get in one step everything, but adding uncertainty on the return to stabilize optimization. I would say to be more visual on the framework, so the first step, and this is on the tactical asset allocation, so not thinking of how we will invest, which could be fund or future or derivative. It's just a classical framework to implement tactical views. So PM, macroeconomist, strategists, whoever you want, will define tactical views on the unconstrained portfolio, taking into account the volatility, so with a risk budgeting portfolio, unconstrained world. We will have a correlation matrix, so risk model, which enable us to combine all the assets together, which is also key for us in the second pillar. The risk model is through a PCA, we are cleaning the correlation matrix to take the most relevant factor economic we have in the market through a statistical point of view. So you have the view, you have the correlation, and then based on that, we are able, by reversing engineering, get the implied return of your active portfolio. And these active returns will be the input of the robust optimization. And you will have strategic asset allocation defined in asset class and all the constraints. And through the process, you will get the pure active portfolio that you want to have at the end. In other words, without constraint and based on that you could have been purely a long-short portfolio, your final optimization will be perfectly in line with your active portfolio, which is what MicroStrategy wants to implement to make the most efficient performance according to their conviction of the market. But this framework is purely an asset class base, so at the end investable through direct line, but not slightly far from what we could propose to end client. So in this process, we will add to the optimization a component which is named a buy list, which is a list of active fund and passive fund, which is represent your investment universe and which is selected according to their feature, for active funds that they have a good track record, for the TF that they have all the characteristics that you could have in mind for selecting fund. And this component is also given to the robust optimization. And at the end, you still have the unconstrained, the risk model, your strategic asset allocation, and all the constraints that you want. And the robust optimization will move through your strategic asset allocation to a tactical portfolio based on the active fund, mixing passive and active fund. what you need to understand is that all asset class and fund are sharing the same DNA, which is first we will define and through the risk model the benchmark or any asset class that you want, which is have on the two components. You will have a beta exposure to a list of core assets, and this list of core assets is for purely European investors, so based on equity Europe, US equity market, emerging on the Japan market, and you have all the grad on European sovereign market and all US market and currency risk. And any asset or benchmark of a fund will have a component on the beta which will be the systematic risk, so your market. You have the residual risk of your linear regression will be set as a thematic risk, and which is the component that is not explained by your core asset class market. When you have defined this benchmark or this asset class, you are able to take into account any fund, which could be active or passive, and you will regress your fund against this benchmark. And then now you will have all the beta against your asset class, which is the thematic and the systematic risk, and you will keep, you will have still a specific component, which will be the active fund, the active component of PM. And in this framework, we have proposed to define the expected return of the active fund as a residual risk time an information ratio of 0.5 for active fund minus the fees of the fund. Which, and rather from passive fund, we propose you have a lower specific risk due to the fact that they are matching their benchmark, and the cost is the information also of a passive fund will be 0, and you have a lower fees. So at the end, you have in this proposed framework, you have a component which is the active return of the fund. And so when you have defined all the fund, active and passive, you are able to define your covariance matrix, which will be a sum of 3 risk components: the specific risk, thematic risk, and systematic risk. And so this the way to rebuild your covariance matrix used in the optimization process. So if you come back to what we want to have, so you have the strategic asset allocation, which could be defined for any client, take into account the constraint. You have the buy list of the active and passive fund, and you want to move to your investable portfolio. And when you zoom into the optimization, as we are working in tracking error versus the strategic asset allocation, in the way of strategic asset allocation, you have what you have defined, and the investable fund will be at null. And the robust optimization will move from the strategic asset allocation to the investable portfolio, named in this slide tactical asset portfolio, and the gamma will be able to calibrate how much you want to active fund versus you want to passive fund in your final investment, taking into account that you have an objective to achieve, which is your strategic asset allocation. When you deep dive to some results in this framework, in the first line of this table, you have the risk budget adjusted by the gamma, which is implicitly the tracking errors that you want to consume in versus your strategic asset allocation. And on the left side of the table, you have 2% of tracking error moving to different objective of tracking error to 0. And when you see that, at the end, the effective tracking error consumed by your portfolio will moving from 1.76. So for really, you want to really have active fund to 0.49, which is residual risk that you will have when an investment of passive index. And when you look at the 3 line below, you have the percentage of active fund on fundamental, active fund on quant side, and passive index fund. And so when you want to have a 2% of tracking error, so according to the gamma, your investment is fully based on active fund. And rather than you reduce your tracking error, you allocate to the active fund and the passive fund, the percentage of passive fund clearly increase, and just moving to, and by a structural condition, reducing the weight of active fund in your portfolio. What is really key, it's a more interesting consequence, is that when you want to move to, you increase your active, the weight of active fund, naturally the optimization will move to more equity fund, which is the fact that the trade-off or the risk return of equity fund will be more attractive than for fixed income fund. In other words, the cost of fixed income will be more important compared to what they could deliver on the active side. When we, it's in this systematic framework, all the funds and these indices have a beta exposure, so you are able to compare your strategic asset allocation in beta transparency. So you look through your strategic asset allocation through beta exposition, and you could have the same process for your investable portfolio based on fund, looking through the beta market, and you will see that for the different tracking error allocated to active fund and passive fund, you will have more or less the same beta exposure. For sure, when you want to have 2% of tracking error on the active fund, you will slightly deviate from the red column, which is exactly what you want to implement and define to clients' engagement. But more or less, when you look at the typically USI equity exposure, the beta, you have the same on the most of the allocation. What is also important to show is that you are able to introduce constraint on whatever you want, and typically in this table we have introduced a constraint on sustainable investment, which could be clearly what retail clients want is to increase their sustainable investment. And you see that we are moving from 0 to 75, so to add a sustainable investment in their portfolio. And when you add sustainable investment, clearly the number of funds will be reduced to, at the end, only 4 lines, but to achieve 75% of sustainable investment rather than the initial portfolio as a constraint on sustainable investment close to 0, or at least no constraint. So this process adds clearly a flexibility to the constraint and to personalize portfolio on whatever clients want. In particular, sustainable investment could be a practice. And again, in this process, when we compare to where we are in the strategic asset allocation defined in asset class compared to the look-through with this constraint, until a constraint of 50% on sustainable investment, you compare line by line, you have very small difference between the goal proposed to the clients and the investable portfolio. So this process, based on tracking error, and is able to add personalization in portfolio with very low deviation in terms of beta exposure, rather than at the end with 50 or even with 75, you have only 4 funds compared to the initial investment, which is very diversified in terms of fund. The last thing is also clearly the process to show you that we take into account also active views on the market, and the table on the left show you that you are very negative on the US market with a conviction on minus 100% to a very large conviction on plus 100% on active portfolio. You see that your tracking error is moving according to your conviction. But which is also very interesting for us in this process is that the active views on the market will be done more through passive fund rather than active fund. Because the way of, you show that the line of the first line, which is active fund, is more stable on the US market, rather than the bottom part of the slide, which is the US equity passive fund, moving to zero until plus 19, to very positive exposition on the US market. And to conclude, that for us it's a framework which is clearly transparent, because we are able to split the risk between different components, systematic, specific, and idiosyncratic market. It's flexible, as we can add any constraint at any time you want. It's a scalable approach to personalize portfolio and industrialize the manner to produce clearly a portfolio, and it's a way to balance active fund and passive fund, which is a request of the market.
Thank you very much, Romain. So we now have the joint discussion by Sylvain Benoit, who agreed to stick to 10 minutes, because we have the award after that session. Thank you, Sylvain.
Thank you, Catherine, and thank you for the invitation to discuss these two papers. So as you have seen, it's two different papers, so I have decided to split my talk in two discussions. So first, let me go back to the first paper about the use of a large language model to help some clients to decide which kind of allocation they should do when they ask for some advice. And so here what we have seen is that as a key contribution, we see that human advisors, they project their own bias towards their clients when someone is coming to ask some advice. And another key element is that it's extremely prompt dependent, and Roman mentioned it, and he's saying that it's highly linked to how much information you provide to the prompt within the prompt, and it will impact at the end the answer from the LLM to the vignette based on the fictive vignette. Methodology, so 180 experienced advisor. The design, you have 10 richly vignettes. And key findings, so high bias is model dependent. So as you have seen, now he has more than 6 or 8 models different based on LLM. And the advice provided at the end are clearly different, even if at the beginning we have the same vignette. Okay. So first comment, you end your presentation by this. It seems that replacing humans with AI doesn't deliver a first best allocation. So because you mentioned the return at a time horizon of 20 years is lower when you are looking at the advice provided by LLM compared to advice provided by a professional advisor. But on contrast, the volatility is lower, so it should be great if at some point you can blend the two components within a welfare implication and to talk about this trade-off between risk and return. And you have also maybe a selection effect because you don't talk a lot within the paper about where are such professional advisors coming from. I have no idea about it. You just mentioned they provide some advice to very rich people, but are they in the US or in the UK? We don't know. We don't know also the investment horizon, what is the usual investment horizon, 5 years, 20 years. The more you project ahead, 5 years, you may get more significant deviation when you compare different advice, and you have no comments regarding the reallocation, as Milo and Marie study in their paper, where at some point the robot asks to do something and you follow. Here you keep constant the original allocation, and I think something is missing here. And in addition, I'm not sure it's really a bias that you are looking at, because it just you condition the prompt by a set of information based on advisor demographics information and about his career, his age, etc. But in your study, it's not like you do a forecast within a regression analysis where you have a performance metric where at the end you can distinguish which model is the best by minimizing the root mean square error, for example, or if you have a classification issue, you want to minimize, you want to get the better accuracy between two models. Here it's not this, so it's why you use the Deming equation to compare to human, but are humans a real benchmark? I'm not sure that the fact you document the output provided by some human is really key. And if you really want to talk about the bias, I think you should take a look to the fairness literature about large language model, because once again here it's what you do simply is to add more information within the form regarding age, gender, personal portfolio, but you do it in a single sentences, and maybe you can split to test how the LLM is sensitive to age only, to gender only, etc., etc. Okay, so I will be pleased to talk briefly about the other part of my comment. Let me move to the second paper, which is a different paper on portfolio optimization. So main question, how to handle tactical views and based on thematic investment, fund charges, tracking error, combine everything in the same approach and optimization. So here the core optimization problem is in this equation 13, where you can see that the solution is invariant to the ratio between the risk budget out of the aversion to alpha, and here we have a trade-off between how do we trust the expectation in alpha provided by active funds versus a more tactical approach. And here what we can see is that the ratio is higher. We will favor funds with positive alpha, whereas then the ratio is lower. We will favor strategic asset allocation portfolio. So some key findings. Once again, high appetite for active alpha means that you tilt toward active funds and with less passive funds, and for sure, as a consequence, the tracking error rise to 1.76%. Okay. General comment, so it's transparent from a mathematical point of view, which is nice, easy to follow, but you have a lot of terms, and at some point it's difficult to find the perfect definition of the term. First question, general comment about the computation scalability. What is the dimension, the maximum dimension that you can use? So here you have a universe of around 20 assets, if I'm not wrong. Is it feasible to more than 20? Here, I think one of the main issues is that you have no out-of-sample performance reported in your analysis. So your study span over 10 years, but without any out-of-sample analysis. Some technical comments. So here, for example, you set an uncertainty parameter, and you set it approximately to half the average ratio, as you did in the previous paper for the equity universe. But is this setting appropriate for multi-asset? Here I would like to see, as you can read at the bottom, some parameter sensitivity over this uncertainty parameter to see how your robust approach is sensitive to it. I do have the same comment regarding the alpha estimation, where here, as you say in the table you present, you say that you set, yes, the higher equal to 0.5 for all the selected active funds and 0 for passive funds, but I would be glad to see the sensitive to this. But you don't talk about the sustainable investment. I think it's something that you can talk together during the lunch. And let me stop here to save time. It sounds good? Yeah.
Thank you very much, Sylvain. Now, we are late, and there's this award ceremony waiting, so I suggest that we close here the session. The good news is that the lunch is right after, so if you want to talk to the speakers, discussants, and if the discussants and speakers want to talk together, they will be able to do so in half an hour. And thank you for attending.
déjà décidé une cliché à temps, juste c'est ça. C'est ça en fait que je m'étais trop posé la question s'il y avait plus que ça. Si en fait, non, c'est quelque chose qui était que j'allais dire, peut-être quelque chose. Parce que les gens. Et comment ça? Parce que l'horizon était juste au fait. Ah d'accord, mais il ne redemande pas de redescendre. En fait, c'est celui qui t'a dit, moi je suis venu de sortir en 2023. Et il dit, ah oui, il avait dit en 2018.
Bien, bonjour à toutes et à tous. Nous sommes ravis de vous accueillir pour cette cérémonie de remise du prix du meilleur jeune chercheur en finance et assurance. Ce prix est remis tous les ans par l'Institut Europlace de Finance et l'Institut Louis Bachelier avec le soutien de la Fondation SCOR pour la science. Et donc je voudrais saluer, inviter à mes côtés Philippe Traînard, directeur de la Fondation SCOR pour la science. Juste quelques mots sur le prix lui-même. Donc, la procédure est une procédure en plusieurs temps. Il y a d'abord une sollicitation pour des candidatures et pour des cooptations qui sont proposées par les fellows de l'Institut Louis Bachelier. Donc, tous les fellows sont sollicités pour proposer des noms. À partir de la liste ainsi établie, le directoire scientifique de l'Institut Louis Bachelier est sollicité pour donner son avis et après quoi, les noms retenus sont soumis au vote du conseil scientifique de l'Institut Louis Bachelier, qui est un conseil scientifique international, et le résultat de ce vote définit le ou la récipiendaire du prix du meilleur chercheur en finance et assurance. Cette année, le jury a eu beaucoup de mal à départager d'excellents candidats et a finalement retenu 2 lauréats ex aequo et avec une mention spéciale pour un 3e lauréat. Donc, nous en dirons un peu plus dans quelques instants. Je laisse pour l'instant le mystère. Je vais peut-être passer la parole à Philippe Traînard pour peut-être nous parler des raisons du soutien de ce prix par la Fondation SCOR pour la science.
Merci beaucoup, Elias. C'est vrai que c'est un soutien un petit peu historique. Je crois que c'est pour nous extrêmement important. C'est vrai que les fondations, on ne sait jamais très bien ce que font les fondations. Ce sont un petit peu des morceaux de bois qui flottent sur la tempête de l'océan des connaissances et des intérêts divergents. Et en l'occurrence, la Fondation SCOR pour la science est dédiée à la recherche scientifique, à la recherche scientifique sur le risque, pour la bonne et simple raison que nous pensons, et que je pense personnellement, qu'une fondation doit quand même avoir un lien avec l'entreprise, parce qu'elle doit trouver dans l'entreprise des compétences pour savoir et porter un jugement sur ce qu'elle fait, un jugement si possible éclairé. Et naturellement, le risque est au cœur de toutes ces considérations, mais ce n'est pas à vous qui travaillez sur la finance que je vais apprendre combien le risque est important et combien dans l'économie et dans la finance, l'introduction, n'est-ce pas, que ce soit dans le cadre de l'équilibre l'équilibre général ou dans le cadre de l'équilibre partiel, de l'analyse en termes d'incertitude. On se souvient tous, pour prendre des auteurs français ou américano-français comme Debreu, Jean-Jacques Lafont, etc., combien c'est fondamental et combien ça a changé aussi notre façon d'aborder les sujets, de se dire qu'on est dans un univers du risque. Et bien évidemment, on voit et on verra que les lauréats abordent cette question du risque fondamental avec des instruments qui sont renouvelés. Et bien évidemment, nous profitons, au fond, on voit se développer des méthodes où de plus en plus s'allient des technologies sophistiquées. On a vu avec l'intelligence artificielle et les problèmes aussi que cela pose. Et en même temps, on essaye de tirer du peu d'informations que nous avons beaucoup plus de conclusions que par les passés, n'est-ce pas? Par exemple, dans l'analyse des risques de plus en plus extrêmes. Et c'est pourquoi nous suivons bien sûr tous ces développements et nous suivons de très près le prix que donne le jury, parce qu'il nous permet aussi, nous-mêmes, de rester toujours, comme on dit, up-to-date, parce que l'un des challenges quand vous commencez à travailler, eh bien, c'est comment rester à jour dans vos connaissances, comment ne pas être battu par les jeunes générations qui arrivent. Ça, c'est le fait de la concurrence et toutes les beautés de la concurrence, n'est-ce pas? Et rester au point sur les nouvelles techniques et en même temps, bien sûr, de se rendre compte que les demandes de plus en plus importantes que nous faisons par des méthodes statistiques très sophistiquées, basées souvent sur beaucoup moins d'informations que par le passé, ou des informations elles-mêmes plus problématiques parce que moins standardisées, moins industrialisées. On voit un ensemble, n'est-ce pas, de défis. Et bien sûr, tous ces éléments font, n'est-ce pas, l'intérêt du prix qui se développe et qui évolue avec le temps, comme on va le voir. Mais je vais te laisser la parole, Eliès, avec les derniers lauréats, les lauréats de la session de cette année.
Merci beaucoup, Philippe. Et donc, je vais appeler nos deux lauréats. Roxana Dumitrescu, professeure à l'ENSAE. Professeure à l'ENSAE, Institut Polytechnique de Paris, après avoir enseigné à King's College. Et j'appelle également Sylvain Carré, professeur à l'Université Paris Panthéon-Sorbonne et qui en est à son deuxième prix, puisqu'en 2023, il avait eu le prix de l'AMF pour ses travaux. Donc Roxana Dumitrescu est spécialiste de finances mathématiques, donc ce sont les approches quantitatives, et Sylvain Carré est spécialiste d'économie bancaire, mais il va nous en dire plus dans quelques instants. Je vous invite à nous rejoindre sur scène. Félicitations. Félicitations. On va vous remettre. Voilà, chacun en prend un.
Voilà.
C'est lourd.
On peut peut-être le laisser dans le. On peut peut-être le laisser. Voilà.
Félicitations. Il y a la petite qui est là. Et normalement, ça devrait.
Okay, so hello everyone. First of all, I would like to thank very much for this award. I feel very honored to join the list of past distinguished colleagues who received this recognition. And I would like also to thank very much the SCOR Foundation, the Europlus Institute of Finance, and the Institut Louis Bachelier for the award. So as requested, I will give a very short view of my research, just to give a bit of flavor of what I was doing so far. So one central question of my research is how can we make optimal decisions when systems are complex, uncertain, and involve many interacting agents? So this is a question which arises in many fields. It arises in financial markets, in energy markets, in the insurance. And so in my work, I'm developing a unified mathematical framework to address this question in order to design robust and tractable decision methods under uncertainty, which are at the intersection of different fields: probability, analysis, and computation. So my research combines three key ingredients. So one of them is advanced modeling. So the idea is to build models which capture realistically the dynamics and interactions in complex systems. Then it's about another ingredient is developing new mathematical tools to solve the problems, and in the end, as the models have to be usable in practice, we have to build scalable computational methods. And all these tools, I use them in various for various applications, which are in finance, insurance, risk management, and more recently in energy transition. So just a first slide with what I have doing almost, I mean, my PhD was on this and a bit after. So on stochastic control, so optimization in a continuous stochastic setting. So here I'm talking about one individual agent. So I was working on developing new mathematical frameworks for stochastic optimization using tools from both probabilistic and analytical methods from stochastic control theory. Then I was interested in designing computational methods which remain tractable in high-dimensional settings. So here I use a combination, let's say, of probabilistic PDE-based numerical schemes and now modern deep learning techniques. And the applications I've working on are in finance, so portfolio optimization, pricing under model uncertainty, and dynamic risk management. Then in insurance, I'm interested in prevention of cyber attacks. So if you think about an insurer perspective, which is the optimal financial effort it has to make in order to to reduce the arrival of future cyber attacks, which are usually modeled using self-exciting OX processes. And in the end, I'm also interested in energy transition. So for example, in storage optimization problems and more broadly, system flexibility. So it's about taking decision when to store or release energy, and this has impact on the price electricity that we try to understand. And also we want to evaluate the impact in terms of efficiency for balancing demand supply. The second topic I've been working on, so I started working on 2-3 years after my PhD. So it's a framework on mean field game theory. So here we are talking about optimization problems, but when we have many interacting agents. So this is a field, the interaction of stochastic control and game theory. What we are, I think a concept which is known to many people from game theory is the Nash equilibria. So this is defined as a profile strategy from which no player has the incentive to unilaterally deviate, considering the other other strategies fixed. So the problem is that usually, I mean, when we consider games with a finite number of agents, they are usually untractable. So mean-field game theory offers a solution. It's an asymptotic formulation of the problem, but which is gives a very good proxy of the equilibria for the finite population, and it has been, it is born actually in the French math community, and many French mathematicians have worked on. So it was introduced by Lasrillions in 2006-07 using PD methods, and then later in about 2012, it's the approach by Carmona de la Rue using more probabilistic tools. What I'm doing is to build new mathematical approaches, and also, again, I'm interested also in the numerical aspects, which are very important in view of applications. So a specific class on which I was working is represented by the mean-field games, where the decision of each individual agent is a stopping decision. So most of the past literature was focusing on games where the individual decision is what we call a regular control. So it's a continuous decision in time, which you do little adjustment, for example, how much you consume at any time. The mean-field games with stopping decision is quite different, because the idea is you decide when to stop or to continue. So it's optimal exit timing from a market, or the optimal time to adopt a new technology. And this is like pressing a button, and the mean-field games with stopping decision represent a very recent area, and represent also a very challenging, much more challenging from a technical point of view, class of problems. So for these particular games, I've been working on developing two new approaches which are complementary. And also I'm interested in developing learning approaches. So when you learn the optimal decision by interaction with the environment, so from data and simulation, without having a full knowledge of the model. And I think this is also very important in view of the application. And then I have also an important part of my research, which is on the energy transition applications of math and numerical tools I've been developing. So one of the applications, if I was talking about mean-field games with stopping decision, is related to long-term industry dynamics. So I'm thinking here about renewable entry and conventional exit from electricity markets. So we are interested in how this mix of energies is evolving over time under different scenarios, and which is the impact of different policies on this transition process. I'm also interested, for example, in designing optimal subsidy policies from the regulator's point of view. And then in this transition process, it's also very important, since, as we all know, renewables are intermittent. It's very important to look on the demand side. So here I've worked on two complementary problems. So one is related to consumers' flexibility, and on the design of incentives to encourage this flexibility for consumers to shift their consumption. And this is based on dynamic pricing. And the other one is related to how to incentivize consumers to make energy savings by designing some reward type mechanism contracts. So I think, I hope I was not too long, and thank you very much for your attention. And I would like also to thank very much my former professors, my collaborators, and also my PhD students for their collaboration and also for their support. Thank you very much.
Thank you very much. Merci beaucoup. Et maintenant, j'invite Sylvain Carré.
Hi everyone, thanks a lot. As Roxana said, I'm very honored to receive this prize and to be now part of the list of the winners. I will start by thanking the sponsors, so the SCOR Foundation, the Institut Louis Bachelier, and the Institut Europe de Finance. I really want to thank them because I think this kind of fostering of research is super important, and personally receiving such an award just gives me an even extra motivation to continue what I'm doing and try to do even better. So thanks to them. So in these few minutes, I'm just going to try to give you an overview of what I did in the past, what I'm doing now, and just a little bit of an idea of how I view economic theory, which is my field. So I will just present my past work. The main goal of this slide is to list all of my co-authors because, as Roxana also highlighted, it's important to remember that we often do our research in team and that we have collaborators who are obviously crucial to the success of our projects. So I started actually working on sovereign models when I was back then a master student of Daniel. I would like to thank him. Unfortunately, he's no longer with us, but I think he was really a key driver in me deciding to pursue a career in academia in economics. During my PhD, I mostly focused on banking theory with two main aspects. One will be informational aspects. So typically how regulators can shape market beliefs, obviously to address some risks such as liquidity risk of run. So for instance, in this Journal of Banking and Finance paper, I look at a question which can be described as follows, which is, okay, let's say that the regulator has collected some news, think for instance about doing some stress tests. Then should they systematically follow a policy of disclosing this news to the market, or should they instead act on a discretionary basis? Another kind of analysis you can do when it comes to banking is look at the balance sheet of banks. This is what we did with my co-author, Daniel Klossner, who was a fellow PhD student at EPFL with me. And here the question we ask is, okay, there is clearly a deep interaction between asset and liability side choices of banks. Why? Well, think for instance about liquidity risk management. Then you have two levers to reduce your risk of run, for instance. You could either increase on the asset side the size of your liquid reserves, or you could decrease your leverage. However, it's clear that in practice, these two actions have distinct roles. And so in this paper, we characterize really how these two things interact. In particular, we show that even if there was no regulation à la Basel III, for instance, it will be optimal for banks to intermediate a lot of liquid assets, even though those have a low return. Why? Because then, because of a multiplier effect that was evident, it allows them to reissue like even more private liquidity to investors. I also want to mention a work in microstructure and insider trading with my former advisor, Pierre-Colin Dufresne from EPFL, who I would also like to thank, and Franck Gabriel, who is still a co-author of mine. And this brings us to what I'm doing now. So I have the same axis of work, banking theory, and now something which is related, but that brings a set of slightly different problematics, which is blockchain economics. And I just want to give one example of the kind of things we are looking at with Frank in this field, and why I think that theory has an important role to play by taking this particular example. So the example I took is the design of interest rate mechanisms in decentralized lending. So as you probably know, in DeFi we have two main use cases. One of them is lending, and it allows to basically replicate some functions of a bank, but in a decentralized fashion. So you're going to have some people who supply tokens to earn some yield, and some people who for some reason have a need to borrow, and are going to demand some quantity D and obviously pay some cost for that. From this you can, so from the state of the protocol and the blockchain, you can observe some variables. For instance, one which is very well known is the utilization rate, which as you can see is simply a ratio of demand to supply. And the question that interests us is not a perspective as is right now where these things are mostly used for speculation, but a perspective in which this lending as a genuine economic value, meaning that some people are going to get some loans that are really useful. And in this context, an obvious but crucial question is how much are they going to pay? In other words, said a bit more technically, what should be the pricing of loans in this context? I just want to note that an important feature of our analysis is that we do consider the risk associated with the blockchain, which is endogenous. So typically, when you are on a proof-of-stake blockchain, it will be secure only if your staking pool has a large enough value. So I think it's crucial to incorporate this dimension of risks in our models. Let me finish explaining what we are doing in this paper. So then the question is, okay, but here I have no traditional price setting mechanism. Okay, there is no valuation market, there is no banker that is going to decide the interest rate. So how are we going to decide how much people are going to pay for their borrowing? And obviously it's a crucial question for the users. So the way it's done at the moment is that we have what we call interest rate mechanisms that are going to be smart contracts, so a pre-specified code that is going to associate to the state variables that are chosen the current cost of borrowing. And you can look at what are the smart contracts that are chosen in practice, but the issue you're going to have, and this was the starting point of our project, is okay, but these mechanisms, we have no clue how they have been chosen, and we don't know what they are trying to optimize, actually. And if you don't think about these fundamental economic questions, you can never make a claim of have I constructed an efficient mechanism or a good mechanism or a mechanism that will be valuable to users? So I guess my point here is that even though we have a lot of data, we can look at what is going on, but it's important also to remember that if we don't think about the economic fundamentals, we will never be able to answer these kind of questions. So we construct an economic framework, like a little theory to think about that. And we are able then to assess whether the current practice is good or not. And we find that it is only the case under some specific conditions, but under other conditions, you need actually maybe to change your mechanism or to consider a larger universe of state variables. So this is a bit what I'm doing in blockchain economics. I'm obviously also continuing to work on banking, for instance, with my PhD student Oscar Lange. We are at the moment working on a paper where we look at the conditions under which a regulator can implement cooperation-inducing mechanisms. So what we have in mind is a regulator trying to come up with a new regulation, à la Basel, for instance, and interacting with banks to get them to disclose some superior information that they may have, and to see under which condition this collaboration will be possible or not. I hope this clarifies a bit what I do and how I view my work. I would like to thank again the sponsors for my award and all my co-authors that helped me so far. Thank you.
Merci beaucoup, Sylvain. Et pour terminer, j'annonce la mention spéciale donc, du jury qui a été attribuée à Paul Voss, qui est professeur à HEC après avoir exercé à la London School of Economics et à l'Université de Vienne. Donc, Paul Voss est un spécialiste de gouvernance, donc corporate governance, et il n'a pas pu être parmi nous aujourd'hui, donc nous avons une petite présentation, je crois, de ses travaux. Pardon ? Ah, d'accord. Donc il a envoyé une présentation qui sera mise en ligne, et donc nous pouvons maintenant vous convier toutes et tous au déjeuner. Et encore une fois, bravo à nos lauréats.